Welcome to Gaur Financial. My name is Gaurav Bholap. The tutorial is on how exchange traded funds work, part 2. Benefits of ETFs. There are four main benefits of exchange traded funds, such as advantage over stocks, diversification, the inherent low expense ratios, and tax efficiency. Diversification. Exchange traded funds are a great way to create diversified portfolios. There are several hundred exchange traded funds that cover every major index such as the Nasdaq, S&P 500, Dow Jones, and more. Also, every sector of the market is covered, including large caps, small caps, growth, value, and more. Furthermore, ETFs offer investment opportunities in regions such as America, emerging markets, country specific such as China, India, Brazil, specific industries such as financial, energy, technology, and niche markets such as gold and REITs. Low expense ratios. Exchange traded funds are cost effective investment options. They give you the benefit of index funds such as broad diversification and lower turnover. ETFs cost much less than index funds in terms of expenses. A typical exchange traded fund has an expense ratio between 5 to 30 basis points, while a comparable mutual fund may have a basis point of 30 or more. One important thing to remember that low expense ratios can be negated by brokerage commissions, meaning if you do a lot of trading, the savings you get by having the low ETF expenses are offset by the huge commissions you pay your broker. Trade like stocks. ETFs are flexible like stocks and the prices fluctuate throughout the day. Additionally, by purchasing ETFs, you are leveraging the entire market or sector instead of just one stock. Also, ETFs are of benefit for long-term investors as well as active investors. And as mentioned earlier, you can basically leverage the entire market with purchase of an ETF. Tax efficiency. ETFs somehow are becoming more and more popular among tax conscious investors. The unique structures of ETFs enable large volume trades with the ability to receive in-kind redemptions. What that means is that as a large investor, you can postpone your tax liability by redeeming your ETF for underlying shares of stocks that the ETF tracks. Moreover, you can choose an ETF that doesn't have huge capital gains distributions or pays dividends, allowing further tax liability management. The disadvantages of exchange traded funds. There are some disadvantages of exchange traded funds. However, the advantages outweigh the disadvantages. Disadvantages concern ETFs are possible excessive brokerage costs of market pricing of ETFs, dividend reinvestment plans, and the ability to purchase odd lots. Brokerage costs. Each time you trade an ETF, a commission is paid. Once you start paying excessive commissions, you start negating the benefits of the low expense ratios that accompany ETFs. Market prices. Mutual fund prices are determined at the end of the day at net asset value. Meanwhile, ETF prices fluctuate intraday, similar to stocks. However, the ETF price doesn't reflect the true value of the underlying assets. Dividend reinvestment plans. Exchange trade funds, unlike mutual funds, do not permit reinvestment of dividends. Odd lots. You can buy and sell exchange traded funds in odd lots. However, some ETFs may not permit the trade of odd lots, such as Merrill Lynch holders. Holders are registered in a different manner than other ETFs, hence allowing trades in only round lots. Now it is understandable why the popularity of ETFs has been so immense since their introduction in 1993. The benefits of cost of ownership are low and offer immense choice and flexibility in investment areas. My name is Gaurav Bhola. Thank you for watching How Exchange Traded Funds Work Part 2. More financial tutorials are available at garfinancial.com.